Welcome back, class, to our Chapter 4 discussion here. So this is just a continuation. In the previous video, we had finished up with our first category of adjusting entries, converting assets to expense. So we're going to just go on here into our second category, which is converting liabilities to revenue. All right. So when would that ever happen? That kind of seems like two strange words to put together, liabilities and revenue. Well, oftentimes what happens with some businesses is they will collect money from customers way in advance before they actually render a service or provide a good to those customers. So what happens when you receive money way in advance from a customer? Well, if someone's giving you money and you haven't provided a service or rendered a good or a combination of the two, then that's actually a liability to you because now you have money in the bank that you haven't yet earned. That's the opposite from when we actually provide a service or a good and someone hasn't paid us yet. It's opposite to that, right? So when you collect cash in advance from a customer, when you collect cash in advance, that creates a liability. If you haven't yet earned that money or done anything to earn that money, then that creates a liability. And specifically, that liability when you collect cash in advance of performing a service or rendering goods, that account is often called unearned revenue. Is that liability account unearned revenue? And I know someone also had asked me in a previous class, what about deposits? Deposits is not wrong. Often, some companies will elect, instead of using unearned revenue, they'll use customer deposits instead. But for this class, you'll see unearned revenue used more often than the second one there. So anytime you hear us talk about unearned revenue, that refers to a liability that has arisen because we've received cash in advance from customers before we actually provide a service or render a good. Okay, so this unearned revenue account, that represents a deferral or a postponement of revenue, because it won't be considered revenue until I actually earn it, do something to earn it, either a portion of it or all of it all at once. Okay, so when you collect cash in advance, that's an entry on its own. But as you earn a portion or all of that cash, that's when an adjusting entry is required. Okay, that's when you will convert a portion of that liability, a portion or all of it, to actual revenue if you've earned it. So you need to not only record the initial collection of cash in advance, which is an adjusting entry, just a regular entry, you also would have to record an adjusting entry at the end of each accounting period to account for any earned revenue since that collection, since that premature collection. So, and again, these examples that I'll be using come from the PowerPoint, so you can look back at those to see these familiar numbers. So remember, from the beginning, the company that we've been using is Overnight Auto. So let us assume that Overnight Auto rents out storage to another company. Okay. Companies can do that, right? So they rent out storage to another company. So let's say on December 1st, Overnight received $9,000 in advance for 3 months of rent. So the company that they're renting the storage space out to has decided to pay for 3 months of rent ahead of time. Okay, so whenever you actually collect cash in advance of actually earning that cash, a liability is created. So anytime, again, when you receive money in advance of doing something or providing something to a customer, it is considered a liability until you've earned that money. Okay, so on December 1st, there's no adjusting entry yet on December 1st. All that's happening on December 1st is I'm collecting cash. It's not a bad deal, right? I'm getting $9,000 cash in advance. Not bad. So that's again, it's not an adjustment quite yet. We're just recording the initial collection of that cash. So on December 1st, what would that entry look like? Well, if I'm collecting cash, cash is an asset that's going up, so I'm going to have to debit cash for $9,000 because I just received cash. I need to update my records for that. And remember, we said as soon as you collect cash in advance of doing something for a customer or providing something for a customer, a liability has been created. And that liability that has been created is what we will call unearned revenue. Since unearned revenue is a liability and liabilities have now gone up because I'm liable for that $9,000 now, I'm going to credit the liability account called unearned rental revenue in this case. To be more specific, unearned rental revenue, I will credit for $9,000. And this could alternately, again, have been called unearned rental deposits, but we'll be using unearned rental revenue here. Okay, and why is this a liability again? Because you got $9,000 from a customer that you haven't earned yet. So this $9,000 is conditional upon you actually providing that rental space. So if next month you decide to stop renting it out for whatever reason, then you're going to have to give them the money back to them, the amount which they haven't yet used up in terms of rent. So that $9,000 is conditional based on you providing that service or that space to them. Okay? So if they are paying you $9,000 for 3 months of rent, we can divide that $9,000 by 3 to figure out what they're actually paying for 1 month of rent. And that comes out to $3,000 per month for rent. Okay? So fast forward to December 31st, what has happened from the 1st to the 31st? They've actually used the space for 1 month as of December 31st. So since 1 month has passed, we've actually earned, because you provided the space to them, we've earned 1 month of rent so far. So on December 31st, an adjusting entry is required to show that a part of that liability, a portion of that $9,000 has now been earned. So a portion of that liability has now become revenue. So since a portion of that liability has become revenue, that liability has become smaller. And anytime a liability becomes smaller, we have to debit that liability. That liability, remember, is called unearned rental revenue. We're going to debit unearned rental revenue now on the 31st for $3,000. And since that liability has decreased, remember, part of that liability has now become revenue. So we actually have to record the fact that we've earned rental revenue. So I'm going to credit my rental revenue account here for $3,000. So that's what the entry looks like when you have now earned money that you, at least a portion, you've earned a portion of money that you received in advance. Okay, so now that we've earned $3,000 of the $9,000, we had to convert part of that liability, unearned rental revenue, to actual revenue. Okay, so that is that for that category. We can go ahead and move on to the third type of adjusting entry, which is accruing. I'll actually rewrite that. Which is accruing unpaid expenses. All right, so remember we said that we can incur expenses before we actually pay them. A classic example of this would be your utility bill, right? You owe that amount on the bill even though you haven't paid it yet. So it's still considered an expense. Or when your workers have put in hours to work for you, that's salary expense to you, although you haven't paid it yet, even though cash is not yet involved. Okay? So an expense is totally possible to be incurred in the current accounting period, even though you haven't yet paid for it, even though payment is going to happen in a future period. So at the end of each month, we have to create or journalize an adjusting entry to keep track of any expenses that have accrued or built up over time that we haven't quite yet paid. Okay, so this kind of adjusting entry will involve debiting the appropriate expense, whether it's interest expense, salary expense, something similar, and you have to credit the related liability. Remember, if you haven't paid it yet, you're not crediting cash, but you would credit a specific payable account, whether it's interest payable, accounts payable, salaries payable. Okay, so this is a type of adjusting entry that recognizes expenses that are going to be paid in future transactions. They're not paid quite yet. So the example that the PowerPoint gives us, again, we're using those examples so you guys have familiar numbers to look at. So let's say that at the end of December, we owe $1,950 in wages that have not yet been paid. And if we owe wages, that means our workers have worked for us, right? We can't owe something if our workers didn't actually perform the work. So our workers put in hours, so we owe them wages. For this company, payday, the next payday falls on January 3rd. So payday is on January 3rd. Okay? So that's why if payday is on January 3rd, we haven't yet paid that $1,950. But although we haven't yet paid it, and although payday is on January 3rd, because we've hit the end of December now, every end of the month we have to make adjusting entries. And since this is an accrual of an unpaid expense, we need to record that at the end of December. So remember, just a reminder, if workers have worked, we owe them the money. If we owe them the money for time worked, that is considered an expense, although we haven't quite yet paid it. So what would that adjusting entry look like on December 31st? So again, this is an adjusting entry. On December 31st, if they owe you that, if we owe them that amount of wages, $1,950, if we owe wages, that's an expense to us, although we haven't yet paid it. So for this entry, we want to debit salary/wages expense. Sometimes you'll see it just as salary expense, just as wages expense, whatever applies to the company. So we'll debit salary/wages expense. We'll debit that for $1,950. And since we haven't paid it yet, right, it's not yet been paid, we're not going to credit cash, but instead we will credit salaries/wages payable. And again, that would either be salaries payable or wages payable, or a combination of the two. We're just using a combination of the two here. So again, anytime you accrue an unpaid expense, you will debit the expense in question and you will credit the related liability since you haven't yet paid it. Okay, so that's what that entry will look like. But let's fast forward a little bit to January 3rd. So come January 3rd, let's see what's going on. Come January 3rd, we now pay the $1,950 owed. Because it's payday, we pay any salaries owed on that day. Okay? However, between December 31st and January 3rd, workers earned more wages. Okay? So just because I made that entry on December 31st, it doesn't mean everyone stops working, right? There's 3 whole days there that workers could have worked, and in this case, they're telling us workers earned more wages. And let's assume that amount is $447. So not only on January 3rd do we have to pay what is owed since December 31st, but we also have to pay them, since it's payday, what they have earned over the last 3 days as well. So how in the world will we journalize that on December 3rd? Or sorry, not December 3rd, January 3rd. And again, this isn't an adjusting entry. This would be a regular entry on the 3rd, since it doesn't fall at the end of the month. All right, so let's take a look at what's happening here. The $19.50 of salary expense has already been recorded. We're not going to double count. We don't want to record that as an expense again. But since we're paying what we owe them, the salary / wages payable of $19.50, the salary is payable. Since we're paying it, has to go down. If you're paying off that $19.50, that liability is going down. But at the same time, this $447 of additional wages earned, okay, we owe that $447. And if you owe that money to your workers, remember we said if you owe that, it's considered an expense. So not only do I have to journalize the decrease of this liability because I'm paying it, but you also have to record this additional expense now, because over those 3 days, they've earned more money. So how much cash is being paid then to them? Not only do you have to pay the $19.50 owed to them as of December 31st, but since it's payday, you also have to pay them what they've earned over these last 3 days. We add that together, then the overall amount of the checks that's going out should be $2,397. So that check, or the total amount of the checks overall, the cash that we're paying, right, cash is going down. I'm paying that much in cash. And cash is going down to satisfy this payable of $19.50 and to actually pay immediately this $447 salary expense. So expenses are further going up. So let's go ahead and journalize that. Remember, expenses are debits. So I will debit salary / wages expense. I will debit that for $447. But I also have to debit the salaries / wages payable account, because it's a liability that's going down now because I'm now paying that liability off. I have to debit that payable for $19.50. And overall, the cash I'm paying on January 3rd is $2,397, so I have to credit cash for that amount. Okay? And again, since it's payday, this is January 3rd, so since it's payday, we not only pay what is owed from December 31st, but we have to pay what is owed for the last 3 days worked as well. So there's 2 accounting periods that are affected with that payday transaction there. Okay. On to our fourth major or general category of adjusting entry, and that last major category is accruing uncollected revenue. So it's possible for us to earn revenue or accrue revenue during the current period, even though we haven't collected that cash yet, even if that cash is going to be collected in the future. Okay, so any earned revenue that hasn't yet been recorded and that you haven't been paid for yet, we have to record an adjusting entry for that at the end of each period to make sure, again, that our total revenue amounts and expense amounts are accurate and up to date. So this one specifically relates to revenue. So at the end of the month, if you've provided services and goods to customers and you haven't billed them yet and they haven't paid you yet, that's when an adjusting entry is required to actually record that revenue as earned and to record that accounts receivable that needs to go with it, or whatever specific receivable it is that we're talking about. So as an example, let's say as of December 31st, we're looking at overnight auto again. Overnight auto accrued $750 of repair service revenue. So again, it looks like they don't just rent things out. They also repair things for people, right? They accrued $750 of repair service revenue from a business called Airport Shuttle Service. We'll call it just from Airport Shuttle Service. This amount has not yet been billed, so not yet billed or paid. So if it hasn't been billed yet or paid yet, it needs to go on the books. It hasn't yet been actually adjusted there in our accounting records. So as of December 31st, we have accrued $750 of repair service revenue. So we provided repair services to this airport shuttle company. We haven't yet billed them and they haven't paid me yet, but even though they haven't paid me yet and I haven't billed them yet, as long as I've provided the service, I've earned that money. So if I've earned that money, even though I haven't received it yet, I still need to record it as revenue. So that December 31st adjusting entry would look as follows. And this is actually an entry that we've kind of touched on prior. So you guys have seen this one before. So if I haven't been paid yet, I haven't received cash, remember the next best thing to cash, the promise of cash in the future, is where what I would refer to as accounts receivable. So I'm going to debit my accounts receivable account specific to this business, their accounts receivable account. I'm going to debit that account for $750. I'm not debiting cash, haven't gotten it yet, but I'll debit the promise of cash, which is accounts receivable. And since I've earned that money, it's revenue to me, so I'm going to credit my repair service revenue account for $750 as well. So that's what it looks like when I accrue uncollected revenue, the adjusting entry to record that accrual of uncollected revenue. All right, so let's take it just a step further. Let's assume that by January 15th, Airport Shuttle Service received another $750 worth of services. So Overnight Auto as of January 31st provided even more services to Airport Shuttle in the amount of $750. Okay, and on January 15th, Airport Shuttle Service paid everything owed on that day. Okay, so there's a couple of things happening here. So on January 15th, or as of January 15th, how much does Airport Shuttle owe Overnight Auto Service? They not only owe them $750 as of December 31st, but they also now owe them another $750 because it says that they received even more services in the amount of $750 as well. So overall, the Airport Shuttle Service Company, they owe Overnight Auto Service a total of $1,500. So that's how much they owe, but it says they paid everything on this day. So this is what was owed and paid by the Airport Shuttle Company. But let's look at that breakdown. Again, so that there's $1,500 of cash that is received now from Airport Shuttle. $750 of that is their settlement of their accounts receivable that we recorded on December 31st. But the other half of that is another $750 that represents what? If between December 31st and January 15th, we provided even more services to this company, we've earned even more revenue. So that's additional revenue that needs to be recorded now on January 15th because we've only so far recorded $750 of revenue. Now we have to record the other $750 of revenue that has been earned as of January 15th. So let's go ahead and journalize that. So we can debit cash because it says they're paying us now. So this is not an official adjusting entry, but we have to journalize these changes on the 15th. We have to debit cash for $1,500 now because they're paying us in cash. Cash is going up. But now I'm going to credit accounts receivable, because guess what? They don't owe us that $750 anymore that we recorded in that prior entry. So we have to credit accounts receivable to decrease it by $750. But this other $750 of revenue hasn't yet been recorded. And there's no need to put it in a payable account because we've earned it and now they've paid that other $750. So I'm going to credit repair service revenue for $750 as well. So this $750 refers to them paying me what they owe me for revenue I earned back in December, as of the end of December. And this $750 is revenue earned now in this next accounting period, specifically in January. So that's what that entry will look like. And that concludes those 4 general categories of adjusting entries. But there is a final kind of adjusting entry. It's not one of the 4 general categories, but there is a final kind of adjusting entry. And that is accruing income tax expense. So as a corporation earns taxable income, it incurs income tax expense, even though they might not pay those taxes right away, right? There's specific due dates. So if a company earns taxable income and they incur income tax expense, it is considered a liability, right? If they haven't yet paid it, okay? So let's assume that as of December 31st here, that Overnight Auto accrued income taxes of $4,020. So if you've accrued these income taxes and you haven't paid them yet, it's still an expense, even though I haven't paid it yet, right? As long as I've earned taxable income, I owe income taxes, which is income tax expense to me. So that adjusting entry on December 31st, I have to record now how much income tax expense I've incurred as of December 31st over this last accounting period. So to record that income tax expense, I will debit income tax expense for $4,020. And then since I haven't paid it yet, I will not credit cash, but instead I will credit income taxes payable for $4,020 as well. And we've successfully gone through all of the most common kinds of adjusting entries that you'll come across. So make sure that you go over these entries to make sure you practice them, because it's really just going to take practice at this point in time. So to finish off this video, we're just going to cover just some last points here. So just as a reminder, when we're looking at adjusting entries and their characteristics, every adjusting entry, it's going to involve either the recognition of revenue or the recognition of expenses. So it's going to be one of those two. And it has to be accompanied by a corresponding change in assets or liabilities. So every adjusting entry affects an income statement account and a balance sheet account. And as a reminder, adjusting entries, it's based off of accrual accounting, not cash-based accounting or cash basis accounting. Cash basis accounting doesn't even bother with adjusting entries, but with accrual accounting, which is necessary for public companies, we have to make these adjusting entries. That really accrual accounting, the main focus is on that. So we make these adjusting entries at least monthly to properly match those expenses with those revenues in each period. Okay, and usually these adjusting entries, it'll be prepared by the professional accountant on staff or the controller of the organization. Okay, so remember the matching principle that we talked about in prior chapters. Remember, the matching principle says that we have to match expenses each period to the revenue that those expenses helped us to generate. Okay, So some of those things that we've learned about in this chapter that applies the matching principle is depreciating plant assets, those fixed assets that we talked about, like buildings, vehicles, etc. So depreciating plant assets. And again, land is not depreciable, so it's not in that category. Depreciating plant assets, measuring cost of supplies used, which we've done both of those entries now. And then amortizing the cost of unexpired insurance policies. And that's just a fancy word for recording the portion of that insurance policy that is used up over time. But the proper term for that is amortizing the cost of the unexpired insurance policies. Okay, so all end of period adjusting entries that involve expense recognition, they're applying this matching principle, putting that into practice. And that is, again, we want to match expenses with the revenue that they help us to generate. So that's why we do these adjusting entries, to make sure we are properly and accurately recording expenses each period, because those expenses were incurred ultimately to help us generate revenue. And as you guys have seen with these adjusting entries, we are also trying to record revenue accurately. So if we can't have expenses accurate but not revenues accurate, we want both of these to be matched up with one another accurately. All right. Next concept that's important in this chapter and every chapter to follow is the concept of materiality. This is a concept that will come up over and over again in accounting classes in the future. So materiality, that refers to the relative, again, the important word there is relative, the relative importance of an item or event. Okay? So an item is going to be considered material if knowledge of that item might reasonably influence the decisions of users of those financial statements. Okay? So accountants need to make sure that anything that's material, any material items, have to be properly reported in those financial statements. Okay? So if something is material, it will necessitate being recorded in the first place, and certain inaccuracies will need to be remedied. So materiality, if something's considered material, that means it is considered to be significant and important. Immaterial items, that would be anything that's not material, and this is how you spell it. Immaterial items do not have materiality. Okay, they are of little significance or little consequence to decision makers. So if someone were to know about an immaterial item, it's not going to necessarily affect their decisions, where a material item would. Okay, and why do we even talk about this? Because the whole financial reporting process, everything that we're doing here, it needs to be cost effective. We don't want the cost of maintaining a system like this to outweigh the benefit that we're getting from it. So that's why when it comes to immaterial items, we can save time by recording immaterial items in a certain way. And if we're talking about a really immaterial mistake, for example, things like that aren't going to ultimately affect the decision makers and the conclusions that they'll come across. So accountants need to figure out where to save time, and they're not going to waste time on immaterial items. Okay, so we never want the benefit of accounting information to be outweighed by the cost of maintaining that information. So immaterial items, we can handle those in the easiest and most convenient manner. So we don't necessarily have to apply those stringent rules to immaterial items, because they're just that, they're insignificant. So accounts will journalize them or record them in the way that's going to be the most convenient, easiest for them. Okay, and whether or not an item is material, it will depend on professional judgment, first of all. So when an accountant is trying to determine if something's material or not material, significant or not significant, he or she will really have to rely on their own professional judgment. Okay, and when using their professional judgment, there are some factors that they will take into consideration. So the size of the corporation, okay, is one of them. the cumulative effects of numerous immaterial events, the nature of the item, and the dollar amount of the item. So, for example, if you are a multi-billion-dollar company, okay, and your secretary needs to go buy some pens, right? We're looking at the secretary of the head office. If the secretary needs to go buy some pens and she spends $20 on pens, will a multi-billion-dollar company or multi-million-dollar company even go ahead and dump those pens into an asset account and depreciate it away over time? Or would $20 be rather immaterial for a multi-million-dollar company? The dollar amount in the item, $20, is probably very insignificant in comparison to all of the other transactions that a multi-million or multi-billion-dollar company would be engaging in. So to save time and to be cost-effective and efficient, accountants most likely will not create a supply account or dump the $20 of pens into a supplies account, but instead they might even dump it into an account called miscellaneous expenses or supplies expense right away. So that's an example of saving time. $20 is immaterial in that case in terms of dollar amounts for that kind of size of corporation. However, if you're a really small corporation just starting out and every transaction has so far been a couple $100, maybe a couple thousand, then maybe, the accountant would say, you know what, based on my professional judgment, $20 at this point in our life, our business's life, $20 is not necessarily immaterial. Let's go ahead and include that as part of supplies, as that part of that asset account, right? It completely depends. But also, if you're whatever size corporation that you are, you also have the accountant's also going to look at, well, how many of these $20 immaterial events do we have? If we have thousands of them a week, okay, well, thousands of $20, that can probably build up to a larger amount. The cumulative total, again, $20 today might be immaterial, but the cumulative effect of that, if we have thousands of those transactions, let's say in a week or even a month, the cumulative amount of that might end up being material, right? So an accountant won't just look at, oh, it's $20, it's nothing. He or she will look at, okay, what's the cumulative effect of numerous amounts of these entries over time? That might end up being a material thing. Okay? So an accountant is going to look at all these factors all together, determine whether or not something is material or not. And we're going to be looking at that as well and keeping that in the back of our minds as we move through later chapters in this class. All right, so that is it for Chapter 4. And Chapter 4's overview, we'll go over some problems in class and get a chance to practice this. So good luck with Chapter 4, and we'll talk soon.